Hi, everybody. My name's Griffin Bridgers. Welcome back to the basics of the portability election. In this part 6, we're going to get into an interesting comparison. I call this the showdown between the AB formula versus portability, but we're going to do a bit of a deeper dive and a visual analysis of what happens in the traditional estate planning formula that's designed to maximize the basic exclusion amount versus what you might be able to accomplish through a portability election from a holistic tax perspective. Now, before we get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And before we get started, if you like this content and you are a tax or estate planning practitioner who has a need for a speaker at your upcoming bar association, estate planning council, or any other type of event or conference, feel free to reach out. I'm happy to be a speaker or presenter for your upcoming programming needs. So, in this series, we've looked at a lot of basics and really just the high level of what law and regulations say around the portability election, along with a bit of a compliance on the 706 as to the mechanism for making the portability election and the mechanism for how valuation is reported for assets that produce deceased spousal unused exclusion. So in this part 6, we're going to dive into kind of a big picture of how portability has changed the estate tax planning landscape and what it used to look like, and get granular in terms of the benefits you get within a married couple at each death when we look at the estate tax versus the income tax and what some of the traditional planning mechanisms might entail. Now, to caveat, a lot of this discussion is going to be focused on estate tax versus income tax. We're going to briefly mention later that there are certain benefits outside of tax that come with the use of trust-based planning that you see within the AB formula. And I don't mean to discount those, but because portability is a tax election, it helps to kind of focus on it holistically from that perspective. And from that perspective, unfortunately, we don't have a crystal ball as to what's going to happen to the estate tax basic exclusion. Recall, the basic exclusion is the $12,920,000 currently under estate tax law that every individual U.S. citizen or resident receives against their worldwide assets. For now, that exclusion amount is indexed for inflation every year and is scheduled to sunset by 1/2, including the inflation adjustments that will occur in 2024 and 2025 on January 1 of 2026. But before then, there are two ways that are commonly accepted that we can preserve unused basic exclusion. One is gifting assets, preferably in an amount equal to the entire basic exclusion amount. I'm not going to get into why here, but that's the only real effective way to do it. But making a gift to a trust that does not run afoul of the proposed anti-clawback regulations, but also recognizing that completed gift trust that will be included as in the grantor's gross estate may be abusive and not actually count as use of the basic exclusion under those proposed regulations. Now, that aside, that's been the tenor of estate planning over the last 2 or 3 years. The more commonly accepted way, which obviously is not a desirable outcome from a personal perspective, but it may be optimal from a tax perspective, is for somebody to die before 2026 and have their executor make a portability election for their unused exclusion. Now, you can't predict that either. The only thing we really have control over is lifetime gifting here. And it's not going to be practical for most families, especially because you have to use up the entire basic exclusion amount, which, even assuming you have enough assets to do so, means potentially you're intentionally impoverishing yourself to fund that gift, maybe even to a slat. And in that situation, that intentional impoverishment can create an implied understanding that you might retain benefits or need benefits from that gift in the future, which can trigger gross estate inclusion and end up meaning that you lose the lifetime use of basic exclusion if the sunset does indeed hit. So with that being said, what's not going to change is, one, the idea that with the right funding formula now coupled with portability, married couples can still create zero estate tax at first death. But the question is going to be the optimal way to get there. So we're going to explore both a newer route and a traditional route to get there, and expose how the newer route used to be the commonly accepted but was inefficient from a tax perspective prior to the portability election. And that prior route that kind of forms the backbone of many estate plans for a married couple is what I call the sweetheart estate plan. Essentially, the sweetheart estate plan just says at first death, leave everything to the survivor. Then the survivor at second death can leave everything to whoever they choose. It could be kids, it could be stepchildren, grandkids, other family members, charity, whatever. Now there's flaws in that from a non-tax perspective, but we're going to focus on tax today, where through the sweetheart estate plan, you get everything to the surviving spouse, qualifying for the estate tax unlimited marital deduction. Essentially, when you give property outright, you cannot apply the first spouse's basic exclusion amount to that transfer. It has to use the marital deduction. That's something a lot of people aren't aware of. The only option to use exclusion for a transfer to a spouse is actually through a transfer into a trust that does not automatically qualify for the marital deduction. It only does so in an elective or non-qualifying method. So, that being said, through the first spouse's estate, we essentially defer estate tax on the combined estate through that unlimited marital deduction to the surviving spouse at second death, with the cost being that the first spouse's exclusion is not used here, as I mentioned. But you do get a basis step up for every single asset. So the first spouse could have $1 billion. You could get a free basis step up for everything and defer estate tax, with the cost being that the first spouse's exclusion wouldn't be used in that scenario. And then at the surviving spouse's second death, we have then an estate tax that's been deferred in part and also applies to the surviving spouse's actual personally owned assets that they earned. And that estate tax right now would be 40% to the extent it exceeds the surviving spouse's applicable exclusion, which can include the basic exclusion plus portability, as we'll see in a few minutes. Again, though, we get a second basis step up. We get 2 bites at the apple here for the step up in basis for income tax purposes. And then we have the ability too, where the surviving spouse could possibly eliminate some estate tax, possibly through the use of portability and the unused exclusion to make lifetime gifts, and possibly even through charitable gifts as well. So that being said, this combo of benefits highlights 2 interrelated aspects here that really seem different but actually affect each other. One is that in the sweetheart plan, the default outcome is that the basic exclusion of the first spouse to die is lost. But regardless of that, we get that benefit that all assets of the first spouse to die get a step up or potentially a step down in basis other than income in respect of a decedent. And that step up in basis can apply twice, as we'll see. Now, prior to portability, this was a bad outcome, especially under a higher estate tax regime. Now, what's important here is not necessarily to look at the highest maximum estate tax rate. You have to consider that coupled with the applicable exclusion, which creates a credit against that estate tax rate. So effective estate tax rate isn't going to be 40%. It's essentially going to be your estate tax divided by your entire estate tax base, which is your taxable estate plus adjusted taxable gifts. So assuming you just had one exclusion here and the other was lost, let's say there was an estate tax base of $13,920,000, which is conveniently $1 million over the applicable exclusion, or the basic exclusion, I should say. and your estate tax thus was 40% of that 1 million, or 400,000. What this means is that your effective estate tax rate, when we take into account that exclusion, wouldn't be 40%. It would only be 2.87%. We actually divide our 400,000 by 13,920,000. So why do we care about that? Why do we care about the effective rate? It's because the applicable exclusion, which is basic exclusion plus dissui, is a free coupon for basis step-up. And it could be a free coupon for basis step-up, giving 2 bites at the apple, where at first death you get an unlimited basis step-up, and second death you get a step-up free of estate tax for that applicable exclusion amount, plus a step-up in basis with the cost being exposure to estate tax, but at an effective rate that might not exceed the income tax rate that would apply to the built-in gain that is wiped out through the step-up in basis. So our outcome here is comparing the effective estate tax rate to the effective income tax savings rate that's achieved through that step-up in basis. In other words, what's the potential income tax on the gain that would be recognized if you were to liquidate everything immediately prior to death in a way that that built-in gain was recognized at the time? Now, I want to remind you that this only is effective, pun intended, for appreciated assets. There can also be a step down in basis, essentially built-in losses at the time of valuation for gift or estate tax purposes can't be preserved in the hands of the recipient, because the gift and estate tax applies to the fair market value of an asset, which does not take into account that built-in loss. So, in the grand scheme of things, in a married couple, especially one with differences in age, we have to consider that there could be 2 bites at the apple for basis step-up. So how do we maximize this in the grand scheme of things? Well, the best starting point here is that with portability now, we can eliminate the concern in number 3 here, that previously the first spouse's exclusion would have been lost. Now it can be preserved for the survivor through the portability election. That will have the effect of 1, reducing the deferred estate tax, and 2, increasing the free coupon for a second bite at the apple in terms of a basis step-up at the surviving spouse's death. Now, beyond that coupon, you'd still have potentially a tax-advantaged basis step-up to the extent your effective estate tax rate is less than the potential income tax savings on the rate that would be applied to a deemed recognition if the assets weren't stepped up in basis. So, against that backdrop, we often wonder, how does this jive with the more traditional AB formula planning, which we're going to look at in a minute, but it helps to give you a history lesson leading into that first. As recently as 2001, the estate tax exclusion was only $675,000, which you can see it's increased by essentially 20-fold over the last now 22 years. And the highest estate tax rate at that time was 55%. With an additional surcharge of 5% for estates in excess of $10 million. This led to a much higher effective estate tax rate, which in most cases exceeded the potential income tax savings that could be achieved through a step-up in basis. So with our prior example where we had a tax base of $13,920,000, if that had been in 2001 using 2001 tax rates, which that's a typo on the slide, it should say 2001 tax rates and not 2021. But back then, the effective estate tax rate on that tax base would have been 52%. Essentially, what we would have had is an estate tax under the 2001 rate table of $7,492,800 minus an applicable credit of $220,550, which was essentially the exclusion amount of $675,000 applied as a credit against estate tax. And that would have given us a net tax of $7,272,250, which when divided by $13,920,000 would have given us a 52% effective rate. So there's no way that ordinary income or capital gains could ever even approach that for stepped up basis assets. But When we get down to 40%, yeah, that becomes more likely when we combine federal and state. But remember, we're not using 40% as our effective rate. We'll never meet 40% as our effective rate if you're familiar with calculus and limits, because the exclusion amount will always keep our effective estate tax rate under 40%. So because the growth of the exclusion has reduced that effective rate, and because that amount now compares to potentially, when we combine federal and state income tax rates, the potential income tax savings from a step up in basis, especially as the effective estate tax rate is lower, only in, maybe let's say 20% or less. The AB formula is less advantageous now. So in the past, the AB formula had the effect of carving off the then much smaller exclusion of the first spouse to die into a trust structure that grew free of estate tax, but as a consequence, did not give us that second step up in basis, which made sense then and may not make sense now. So let's see, what does the AB estate plan look like? In this case, we have the sweetheart plan, but essentially what we're doing is, at the death of the first spouse, carving off into two irrevocable trusts, one being a credit shelter trust, which holds the remaining exclusion amount, which is essentially that basic, actually I'd say the applicable exclusion amount minus lifetime gifts, because as we'll later look at, you could potentially preserve a disuee through the credit shelter trust if the first spouse to die had been widowed before. And then the overage would have gone into a marital trust, which would have deferred estate tax again through the marital deduction if the marital trust qualified for the Q-tip election or gave the surviving spouse a general power of appointment. But at second death, the outcome would have been slightly different in that only the marital trust and survivor's estate would have gotten a step up in basis, with the trade-off being estate tax of 40% on that combined pool of assets sourced first from the marital trust under Code Section 2207 Cap A potentially, with the rest coming from the surviving spouse's assets. But the credit shelter trust would have, as long as it was intact, continued to grow free of estate tax or GST tax, but again with the trade-off being no basis step up. So, as I mentioned, the inefficiencies here were that lack of second step up in basis and the inability to fully fund the credit shelter trust potentially if the first spouse to die did not have assets that equal or exceeded their unused exclusion at the time. So the exclusion used to be a use it or lose it proposition prior to portability. And even if you used this plan, you potentially had the ability to lose the unused exclusion if the first spouse did not have enough to fund the credit shelter trust in full here. So often you needed an equalization of assets between the two spouses, usually in a tenant in common type of form that didn't create an automatic transfer to the surviving spouse. So while the credit shelter trust had some benefits and was intact, it could grow free of estate tax because it was designed to never be included in the gross estate, except perhaps maybe a GST non-exempt share if one existed. Now, that benefit of future growth would have extended to potentially capital gains within the trust as well, as long as they're not recognized. But if those capital gains are recognized in the future, potentially they could be taxed to the trust at higher marginal trust income tax rates. The alternative might be passing through those capital gains to the beneficiaries at a lower effective rate. But again, doing that means that trust is no longer intact with respect to those assets. You've recognized the gain, but now you've exposed those capital gain assets, usually through a principal distribution, again to a higher estate tax when the beneficiary dies, along with potentially a GST tax as well. So distributions that passed through gain often went contrary to the estate tax purposes and savings of the credit shelter trust. Now that aside, I mentioned before with the AB plan, there were a number of non-tax benefits and even some other tax benefits we haven't discussed before. One being that in the sweetheart plan, the survivor controls the combined estate fully and can remarry and pass those assets on to a new family at the expense of the heirs of the first spouse to die, or in a blended marriage scenario, to their own kids at the expense of their stepchildren, i.e. the children of the first spouse to die. So this AB plan often prevented disinheritance in the event of remarriage, at least with respect to the assets of the first spouse to die. Descendants also had the ability to immediately benefit from the credit shelter trust without the need for the surviving spouse to make lifetime taxable gifts to them. And potentially, too, you had that ability to defer estate tax using the surviving spouse's higher estate tax exclusion, but with lower estate tax rates through marital trust if the exclusion went up and if the rate went down. So deferral is always the name of the game, and the more you can defer estate tax, the better. So beyond this, the only thing that portability really changed when we look at the AB formula is shoring up that issue that pops up if the first spouse to die doesn't have sufficient assets to fund the credit shelter trust. But portability opened up a world of options when we go back to the sweetheart plan to get the best of both worlds. So in this case, using portability as a feature of the plan and not just simply an option gives us the ability to combine, instead of having a separate credit shelter trust and marital trust, we can have one instrument that funds the marital trust in full as an entity, but then passes off the authority to the executor or trustee, and possibly even the spouse, to make elections post-mortem that allow the first spouse's exclusion to be used if it makes sense from an estate tax perspective when compared to the income tax savings, and vice versa. So you can have a marital trust, and you can make a Q-tip election with respect to some or all of the assets. The Q-tip elected assets would have the same treatment as we see in the sweetheart plan, in that they would be subject to estate tax at the survivor's death, but would get a basis step up, and that estate tax would be 40% over the combined basic exclusion of the survivor plus the unused exclusion that's still available from the first spouse to die. So you could double that up, and then the marital trust could also have non-Q-tip elected assets, which could become a credit shelter trust through a Clayton Q-tip election, or could just still be a marital trust in structure and form for distribution purposes, but wouldn't be included in the survivor's gross estate. It would function like a credit shelter trust in that regard, in that it would carve off and use and preserve the unused exclusion of the first spouse to die. So essentially, you can preserve unused exclusion either through or both through the portability election and or by not making the Q-tip election. Alternatively, the survivor could disclaim assets from the marital trust into an alternate credit shelter trust, or through that partial Q-tip election, the non-elected Q-tip assets don't have to qualify for the Q-tip election after that election is not made with respect to them, allowing the marital trust on the left to be administered like a credit shelter trust in a non-Q-tip qualifying form. But again, the trade-off, like in the AB plan, is that for that portion of the marital trust or alternate credit shelter trust, we get estate tax-free growth on that base amount, but with the trade-off of no second basis step-up at the death of the surviving spouse. So this is kind of a snapshot of what a lot of families do now, with the same benefits of the AB plan, but with a little more flexibility, in that instead of simply deferring estate tax to the second death and forcing the surviving spouse to have to deal with that, we give them or the executor or trustee the power to call multiple audibles. They can disclaim to a credit shelter trust. They can make a Q-tip election for the entire marital trust, because portability now allows us to make a Q-tip election in excess of what's needed to zero out the estate tax. In doing so, they could preserve the entire basic exclusion amount of the first spouse to die through the portability election and pass that on. And or They could make a partial Q-tip election again, such that the unelected portion of the marital trust uses the estate tax exclusion of the first spouse to die, with the added alternative that the Clayton Q-tip election could allow that non-elected portion of the Q-tip trust to be administered as more of a credit shelter trust, which allows descendants, for example, to be beneficiaries and doesn't require all income to be distributed to the spouse on a year-over-year basis, which could create a better income growth potential investment in that the assets of that Clayton Q-tip election don't have to be invested to generate income, but instead could be invested to generate growth. So most often at the top of the bell curve, where you get the best benefit here, is with option 2, which will most closely mirror the Sweetheart plan in that we get 2 basis step-ups. So what are the trade-offs for our 2 basis step-ups in option 2, if that's the full or partial outcome? Well, there's a few of them that we should know. One, there's obviously going to be some estate tax then potentially at the survivor's death, to the extent the survivor's estate plus the marital trust, or at least the portion for which the Q-tip election was made, exceeds the sum of 1, the survivor's basic exclusion, and 2, the deceased spouse's unused exclusion that was preserved through portability. Now, those two move opposite from each other. The basic exclusion of the survivor is exposed to the 2026 sunset, but is also eligible for inflation adjustments, with the trade-off being that the deceasee is not exposed to the 2026 sunset, but is also a static amount that's not eligible for inflation adjustment. We also have to take into account the potential step down in basis for loss assets. This could be reduced potentially by harvesting losses within the marital trust, especially in the surviving spouse's later years. We can also look at the loss of estate tax-free growth in those Q-tip elected assets that we would otherwise get in a credit shelter trust. And essentially that portability amount too, since it's static, also reflects that loss of estate tax-free growth, but in a different form than a qualifying trust. And perhaps most importantly, we can't look at estate and income tax in a vacuum either. We have to consider the GST tax and consider that there's no portability of the GST exemption if the portability election is made. But we do have the ability through the reverse Q-tip election to allow the first spouse to die to allocate GST exemption to the Q-tip portion of the marital trust, such that the survivor could then allocate it to their own other assets or to the non-Q-tip portion down the road if they wanted to. So, big picture, portability in a plan that focuses primarily on funding a marital trust at the expense of a formal credit shelter trust is going to reduce our sunset exposure potentially, and also increase the potential for a second basis step up, but with the cost being the loss of transfer tax-free appreciation in a credit shelter equivalent. So we could have, alternatively, under the AB plan, a GST-exempt credit shelter trust that could grow free of transfer tax, but not income tax, as I mentioned, which is the issue. And the equivalent will be the deceasee, which remains static and is not in trust form and does not grow over time and doesn't have any rate that would match inflation or typical market appreciation. Now, as we'll next see in a later installment, the surviving spouse, if they have enough assets, could potentially use this even outside of a marital trust through the deceasee to possibly create their own mega credit shelter trust during life or even at death. So during life, that could be a slat if they're married, or maybe a trust for descendants or other family, with the trade-off being that mega credit shelter trust will be GST non-exempt to the extent it's funded using the deceasee. So the other spouse, or potentially the non-skip beneficiaries, may need to allocate their own GST exemption to that trust. But the gross estate inclusion that's used to allocate GST exemption at the death of other beneficiaries could create additional basis step-up opportunities, but that's a subject outside of the scope of this series. So I know this has been a long one today, but our wrap-up item here and our takeaway, if you remember nothing else here, is to always compare the effective estate tax rate at both deaths to the effective income tax rates, both federal and state, because the outcome here is that regardless of the plan you use, portability has now opened up a world where at first death, you can get an unlimited basis step up for an unlimited amount of wealth, but you can have a much larger second bite at the apple if the surviving spouse outlives the first spouse to die for a significant period of time, such that there's additional appreciation in the value of assets. And we're in a world now where it seems inevitable that state and federal income tax rates are going to go up at some point in the future. So in that world, it hurts to consider estate tax in a vacuum, especially in a world where that effective estate tax rate, or even the top estate tax rate, could, in the future, be less than the potential marginal income tax rate that could apply if we did not get that step up in basis. So ultimately, portability is going to give us an excellent opportunity in the planning world for income tax savings if and when the numbers shake out through that comparison in rates. So what's next? We're getting close to the end of this series, so thank you again for your patience in this longer video, but there's a lot I felt that needed to be combined here and gotten out in a holistic manner. So coming up, we're going to look at gift tax strategies, the application of the DSUI on the Form 709, coupled with lifetime gifting strategies, some of which I touched on here at the end. We'll also get into how the Q-tip election factors into and affects portability, and also the question, does the surviving spouse have to be a U.S. citizen to use the unused exclusion preserved through a portability election? Not to be viral, but the answer may shock you. So, as always, if you're a tax or estate planning practitioner and you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. And if you enjoyed this content and you like a speaker for any of your upcoming events, be it for an estate planning council, CLE program, bar association, or in-house conference, please feel free to reach out to that email address as well. But I thank you for listening to this somewhat lengthy video here, and I look forward to seeing you in my future content.